Hello, everyone. Good Saturday morning. I hope that you guys are having a fantastic weekend once again. And my name is Derek Clifford. I am the founder and CEO of Elevate Equity, and I'm excited that you're here spending your Saturday morning with us to learn about real estate topics and to get yourself into the real estate game. So we're excited that you are here. Today, we're going to be covering one of the fundamental basic tenets of real estate investing, which is understanding whether or not you're investing for cash flow or for appreciation. There's a big difference between the two, and we're going to really start as to why it's important and what it is. Cash flow investing is like more of the traditional sense that you think real estate investing is. You buy a property, right? And then you just let it cash flow. Like there's income stream that comes in from the tenant who's living in the property or properties, or I'm sorry, tenants living in the property, paying you rent over time. And over time, that will help you pay all of your bills, including your financing and mortgages and all of your property taxes and property managers, and pays for your team and your overhead. And you should retain a profit for holding that property in the end. That's on one side of the fence. That's the cash flow investing. Then you've got the appreciation investing, which is you're buying the property and maybe there isn't a cash flow. Maybe it breaks even. So when you buy the property, the tenant just pays the mortgage or pays the rent to you, and you have just barely enough to cover the mortgage, to cover all of the expenses on the property. Now, the good news about properties like that is that they tend to be more desirable, so they increase in value more. So on one side, you have the cash flow play, which is properties that tend to be a little bit rougher in the beginning, and you can harvest cash flow while you're holding it. And then you have appreciation-based properties, which are properties that maybe you don't get any cash flow at all, or maybe you even have to write checks just to hold the property when you're holding it, even when there's a tenant inside. And then you get the increase in value at the end when you sell the property. And which is best is a very tough question to answer because it's very personal. It depends on what your personal situation is. So it's really very important for you to understand what your risk tolerance is too, and the resource levels that you have and your knowledge and who your network is, because all those factors will help determine whether or not it makes sense for you to go down the cash flow route or go down the appreciation route or some mixture of the two. All right. So some things to think about is, do you know yourself to be a risk taker? Do you enjoy going in there and trying to get your hands dirty and solving problems and want high risk, high return? So maybe you have more time and less money available to you. Maybe that's the route. Maybe you go down like these rougher C-class properties, which we're going to explain in just a little bit. If you are the route where you're like, you know what, I just don't want to deal with the headache of that. I want to buy properties, but I don't want the headache. I just want to go for just something that's nice and something that I would personally live in. Then you go for B properties, B-class properties, ones that probably when you buy them will not make too much sense to hold right away because the tenants will be paying for everything, but you'll have net zero, or you'll have a small amount to pay the mortgage each month, just a little tiny bit. And then in the end, you get a nice little appreciation pop because the value is very high. There's a spectrum there. I personally like to stick right in the middle where there's some appreciation and some cash flow. And we're going to get into in just a second how this all works and what the terminology is behind all this to help identify whether you're looking at a cash flow property or whether you're looking at an appreciation property. So the first thing that we're going to do is we're going to look real quick at what it means to be an A, B, C, or D property. For those of you who have my book already, this image should be no surprise to you at all. There are 4, in general, property grades that we look for when buying property, and we like to call a property what it seems to be. The A property, as you can see here, is like a downtown luxury apartment complex. That's something that is like right in the middle of the city, super high price. So, the rents are high, but the price is even higher. So if you tried to make an investment here, it's a very stable return because there's lots of demand. People really want to be there. So unfortunately, you'd have to pay a lot of money to go there, right? So the rent to price ratio is very, very low, okay? And then the D property is on the way other side, right? No one desires that property at all. But if you can get someone in there, because the purchase price is so low, the ratio is extremely high, okay? So you have the rent to price ratio being very, very low on an A because the price is high and then the rent is low. And then you have the opposite effect going on the D class property. And there's a reason for that. It's not as desirable and it's rougher. There's things that you have to fix up. So in between those two extremes, there's C and B, and that's where the real opportunity is in investing in real estate. And I like to call the C class assets more cash flow, C for cash flow. And then the B, I like to call appreciation. I would call it, I would say an A class is also appreciation as well. So maybe you can think about it like that. But I generally like to invest in C and B properties, in C and B areas that are in the path of progress, that are moving up towards B and A, okay? So anyway, that being said, you can think of C class as cash flow and B class as appreciation properties generally. But sometimes there's a mix between the two. You can have B minuses and C pluses. And going further here, this is just a little bit more of an explanation. So for those of you who are number oriented, real quick to just put some numbers on here, you can see that a property in an average Midwestern market that I am invested in, a C-class rental, back when I was writing this book, you could get a C-class rental for about $85,000, and then your total cash flow would be about $100 plus per month. And then on a B-class rental, if you were lucky, you could probably get break even or maybe $40 a month, depending on if you found a really, really good deal, okay? And that's kind of the way that it works. So again, C-class, having $100 to $150 per month in cash flow every single month is great, but it's also good to have that increase, that high demand property, the B-class rentals that maybe don't have much cash flow, but they appreciate up a lot. Okay. And one other thing I wanted to mention here too is that because the Midwest tends to be a place where there's a lot of more inventory, and it's also just a less desirable place to be. Not that I'm saying that it's a bad place to be, but in general, there's more demand for housing on the West Coast and East Coast. So those coastal appreciation type properties, they're more expensive. So you see more homeowners there. And so there's more demand for people to own their own homes. Whereas in the Midwestern cities, the prices are lower. The jobs pay a little bit less because that's just the way that the cost of living dynamics works there. So you can have people that would be able to move into rental situations for lower money. And so there's less desire there. There's less competition for homeowners to be in that market. So that's why you see the lower purchase price, but the ratio still works out in your favor if you're going to be going for cash flow. So what I like to do is I like to buy appreciation properties in Midwestern markets. So in my opinion, just the way that I think about all this, and you may have your own strategy based on what's important to you, is that I like to see a blend of both of these things, because you don't want to depend on just one thing. You want to have some cash flow to be able to choose your exit, to have the luxury of being able to decide, okay, now the property is increased in value, it's time for me to sell, okay? So that's really important, and that's all that I really wanted to share with you on the graphic side. Now I just wanted to bring it back home and talk to you guys a little bit more about what you're going to be finding when you start exploring properties in these markets, right? You're going to see that the cash flowing properties are the high risk, high return, also high cap rate, which is another term for high price to high rent to price ratio. If you take out the expenses in there, high rent to price ratio, but it also has high headaches and a high time commitment. So everything there is really, really high when you're doing the cash flowing properties. But it is a good way to cut your teeth if you don't have too much money at all, because they're generally cheaper. So you can get into those things. And as long as you're committed and you understand what you're getting into, I do recommend using that as one way to get your foot in the door. The other is appreciation properties. This one is more low risk and low return, at least while you're holding the property. And there's lower cap rates, which means that the rent to price ratio, it representatively is lower than what you could find on the cash flow side. But in general, there's low headaches and low time commitment because it's so desirable. You have much bigger tenant pool to pick from. And you also have another exit strategy, which would be able to sell really quickly because there's so much demand and desire for that individual spot. It just means you're going to have to overpay a little bit, and your financing payments in order to sustain that purchase price with the rental income the way it is not going to work out as well for you on a cash flow basis. And tenants are always looking for a good deal. So if you have a tenant that knows what they're able to spend and they're more of a white collar and they want to save money, they're going to be really competitive and try to not pay as much rent as possible for a good product, which would be your property. Okay. So over time, your strategy will evolve. You may start with cash flow properties, but don't think that you're just committed to that strategy for good. Once you are in the cash flow properties, you may understand, oh, you know what, I actually think this is not working out too well for me, but I do want to try, doing some appreciation properties that are a little bit more expensive, maybe a little bit less cash flow. And over a long period of time, as long as you buy right in areas where both cash flow and appreciation properties are in the path of progress and you see development there, and you're making sure that you're talking with your agent on the buy that it's in a good location where things are moving towards the property, then you should be in a good shape because you'll have the ability to sell for increased price, or you'll be able to just wait with the cash flow properties. You fix up the property as you're holding it, and you use the cash flow to reinvest back in the property. And then that way you're able to gain on some of that wonderful appreciation that comes down the corner, okay? So it will evolve as you learn more about the market and about yourself. And as your personal situation changes, you may used to have all this time to be able to invest and start looking at doing these really cheaper properties and doing rehabs and trying to manage headache tenants and just waiting for the area to kind of go up or try to force appreciate the area. And so that'll take a lot of effort and energy. And if you don't have that, you might want to just go ahead and start working in the more established areas. And like I said, over time, you may find yourself having kids, getting busier at work, getting promoted. And so you may want to shift your strategy into more of the properties that have more appreciation, but less immediate cash flow. And that would be low cap rate properties. So that's just a decision for you to make. And so that's really just your own personal decision. And it depends on your timeline and what your investment goals are. So again, comes back to really, really understanding your goals. And once you understand your goals, you can kind of back out a strategy and help execute. So that's the message for today. I don't want to take up too much more time on your Saturday, so I hope that this was informative. And if you have any questions at all, please reach out to us or engage with the content right here. And once you do that, I'll be notified and we can have a direct conversation through YouTube or Facebook or wherever you're watching this. And we just hope that it was useful to you, and hope that you have an awesome day. And we're looking forward to adding more value to you in the future. We will see you guys next Saturday. Take care.